Income Tax 2020, Practice Problem 1, Part 7, Data Input related to state refund, unemployment, and winnings. In other words, gambling winnings. Come in, relax with Income Tax 2020. Here we are in our Lacerte tax software. You don't need the Lacerte tax software to follow along, although I do think they have a 30-day free trial. So if you can get access to a demo version or promotional version of that or any software, might be a good tool to use. We're going to be continuing on with our practice problem, this time focusing in on some of the items that are usually kind of smaller items to the tax return that could be included in income. Remember, in prior presentations, we've been entering the income items, sorting our documentation that we might get from a client or our own return, then organizing them in our Adobe Reader here so we could put them in relevance to the return, typically W-2s then being first. Then we went to the dividends for dividends, the interest, and then the 1099s for stock sales. Now we're going to take a look at some other of those 1099 items that are usually kind of smaller or things you were less likely to see. You won't see them as often. So if I'm going to go then back down, this is what we have thus far. Married filing joint taxpayer. We got the $80,000 from wages, W-2 wages for both spouses, husband and wife. We've got the interest income, $1,380, $150 tax exempt income, $1,750 of the qualified dividends, or I'm sorry, $1,750 of dividends, $1,300 of them qualified, $3,000 capital loss thus far. That gives us the $80,130 of the total income. That's kind of what we're focusing in on at this point. Going then to our data input. So our data input now, we're going to look at these last three items. The first one's going to be for unemployment compensation. And then we have the state refund that we could have, and then we have a gambling winnings here. So the most common of these three, let's put the most common first, is probably the state refund, depending on the state that you're in. If you're on a state with income tax, then it's possible this will be the most common one, then probably unemployment, and then the gambling winnings. I mean, it depends on your clientele, but so if we go then up top here, we got the state refund. Now again, this will depend on what state you're in. So for example, if I'm in California, so then California has an income tax. So then income tax could mean that you're paying into the income tax, and you could have then a refund. And that refund, you might ask, well, why would that be taxable? If it's a refund, that means it's basically giving you back overpayments. It would only be taxable if you itemized and got a benefit from it in the prior year. So if you itemized your state taxes, meaning you got a deduction. If I went back over here, this is the confusing thing about the taxes. If you took the itemized deductions on Schedule A, meaning we didn't take the standard deduction but took the itemized deductions on Schedule A, then in the prior year, and we overpaid, that means we got a deduction for amount that we got back. They just gave us back the money, and we got a deduction on the federal side for the state taxes, even though we didn't really pay those in taxes because they gave it back to us in 2020. So that means if we got the deduction last time, we're not going to amend the prior year return, but rather include it in income. So then we have to determine whether we got the deduction or not. So what will typically happen is when I do the data input here, most people that don't really have a grasp of that concept will say, well, why didn't that show up in the tax return? And it'll only show up in the tax return using tax software. You should only put it in the tax return if they got a benefit from it last year, the software helping us to make that determination most of the time. So when we do the initial data input, then you may not really know. You might just be doing the initial data input, and maybe you're going to go back and check it at a later point. That's kind of the assumption that we will make here. So in other words, we got the state income tax. It's on a 1099, so we would assume that it could possibly be something that would be included in income. And we got the state or local income tax refund. So I'm going to go into my data input, and I'm going to say, all right, data input. It's going to be some kind of income line item, and so it's going to be state refund. Let's go there. And let's just call it the state, California, whatever state you're in. We'll call it it's California here. And then we're going to say that it's going to be the tax refund. So we have a tax refund, and that is going to be for the amount of the $2,700. So most of the time what will happen is you put in $2,700 into the return, and then you go back to the forms, and you're like, well, nothing happened. Nothing happened in the forms. What happened? Why not? And then you got to kind of know that the software is trying to help you out as to why it would be included or not. But if you don't know why, then it could be kind of frustrating. So you would expect then that it would populate here on the Schedule 1 in the top line for tax refund. You would expect it to be there, but it's not because the likelihood is that we did not itemize last year. Why is that? Because we're not itemizing this year. We're taking the standard deduction thus far. So most likely we took the standard deduction last year, and if we took the standard deduction last year, we didn't get to deduct the state income tax on the federal tax return in 2019, and therefore we shouldn't have to include it in income this year. In other words, we didn't get a benefit from it last year, therefore we don't have to record it as the bad thing, like income that would be taxed on in the current year. But I'm not done with the return, so I might want to just jot that down. I might put that in my open items, and I say, state refund. So did they itemize last year? It is not included in income at this time, right? And we can then go back into it and look at the last prior year tax return, kind of double check that if we want to. If we want to just kind of do the data input and jot this stuff down as we go and just double check it, that could be a good way to go. Because then you're in data input mode, and then you can go into like double checking mode at a certain later time. So now let's go then to the unemployment. So probably more common in 2020 that we'll see the unemployment here. So unemployment compensation. So I'm going to go back on over, and we're going to say, all right, that is something we have to include in income typically. So I'm going to say add, and I'm going to say let's say the state again for unemployment. And I'm going to say that we got, what did we get for unemployment? $300. $300. Not very helpful. That didn't help, but we're okay. We're doing okay here. So then that's 300, and then we're going to go back on up top. Say unemployment compensation. That's going to be included here. We see it flowing in then to line 8. So that then is coming from Schedule 1. So we see it on Schedule 1. It's down here on unemployment compensation on line 7, adding up to line 9. And the 300 then pulling over to the first page of the 1040. There it is. We do have to include that in income. If you had any withholdings on it, then you can enter the withholdings here as well. You can enter the federal withholdings, and that would then show up, of course, on page 2 of the 1040, just like it would on like a W-2 type of form. So then we're going to go back on over and say, all right, that's that one. How about the W-2 for W-2G for gambling winnings? Now, I'm not sure 600 would be above the threshold for them to be required to report, gambling winnings, but we're gonna add it here. So we got the gambling winnings. We should include any winnings that we have anyways, whether we get any form in it or not. Every time the slot machine gives you like $5, you should be writing it down for taxes. So we're gonna be going here the $600. So this is gonna be $600 now. Obviously, when you have the gambling winning, the first thing that's going to pop to people's mind is, well, what about all the losses that I had, most likely? Do I get to take those? And you only get to take those if you had, if you're itemizing, basically, and you could possibly take them up to the point in time or up to the point of the winnings. So that's typically the question that'll come up if you see this type of form. Often a question might come up, well, should I save my loss receipts? Do I have to save the receipt every time I lose money? If I like to gamble and every time I lose money, do I have to save the receipt? Well, if you're itemizing, it might be worthwhile because you want to match out the winnings and the losses to the degree that you can. But if you're not itemizing and you don't gamble that much, then it might not be worth your time to do that because it would only take effect if you hit, if you had some big winning that happened that you could take the losses against. So in any case, then we'll go back on over and say, all right, now we got gambling. Where does that go here? So that goes into like other. We'll put it up top in Schedule 1, and it's going to go into this other line. So other income on Schedule 1. I'm going to try to jump there in my software. I'm going to say I want to jump to that screen because that's where I think it should go. So 1099G for the, that's not it. I'm down here on the gambling win, the W2G for gambling winnings. Gambling winnings. And then we had the casino. Where did we have this? It was San Manuel Casino. And so I'll put that there. And who won? Who did the winning here? Jane did the winning. So it's going to be for the spouse. So spouse and then $600. So gross winnings, $600. We got to do the address and all that. So I'm going to say that's in 777 something, and pull that over and up, and then it's going to be Highland, California, and 92. So there we go. And I'm not advertising this casino or anything. I'm just putting it there for examples. And there we have it. So then I'm going to go back up top and say, okay, so that should pull in the 600. So there's the 600. We've got the 900 now on line 9. And then we're going to pull that up to page 1, which is now pulling into the 900 on line 8 of the 1040. So you can see no one of these items that we have input for all these income items are confusing, but when you put them all together, you can see that you can easily, think, okay, what if I miskeyed something, I misdata input something? You got to kind of double check it. It gets a little bit confusing when you add it all together. So at this point, we've got the W-2s, 2 W-2s that we had. We had the $1,380 of interest, and then we had $150 of interest, which was tax exempt. We had the $1,750 of the qualified dividends. $1,300 of those $1,750 were qualified dividends and therefore be taxed at a favorable rate. We had the $3,000 of capital loss, which was capped at $3,000 because we had more than that. And netting out against the 300 income, we had a net capital loss greater than 3,000. We're going to have to carry forward, I believe, the 400 capital loss to the following year. 900 in other kind of miscellaneous income stuff that brings us to the 81,030 in the total income. So that's our total income. We don't have any above the line deductions at this point. We'll talk about them later. And then we've got the 24,800 in the standard deduction because we're not itemizing at this point. That gives us the 56,230 for the taxable income. Then we're going to calculate the tax on it, relying basically on the software to do so. Tax calculated at the 6,196. And then we've got the W-2. The W-2 down here for the amount that was withheld, $8,000. So we have the overpayment of the $1,804 at this time.